my name's Ben Lofthouse, and I manage the Henderson International Income Trust. We have, I've got a picture of me here, just so people can put a face to a name. We launched this trust in 2011, and when we launched it, the aim was to help UK investors, so people like yourselves, diversify your UK equity income holdings. And so we had a lot of great trusts here and great products here that provided UK equity income, but it's quite concentrated. I'm going to touch on some of those areas as we go through this presentation. And the aim of this was to provide something that gave you access to some different sectors, some different growth dynamics around the world. And the key thing we look for are companies that are leaders in their field, that can grow income, and then we think if they're growing earnings and they're growing income, the capital can grow as well through time, and looking beyond the UK. In terms of when we think of the kind of key characteristics of Henderson International Income Trust, we have a wide portfolio of investments spread across a number of different areas, and that is on purpose. That is for diversification, to make sure you do have the opportunity that you as investors can invest in a China fund or a UK small cap fund or a infrastructure fund. Well, we designed ourselves to be more diverse than that, so that we provide more of a diversification in times of stress. We are value orientated. I would say we're not deep value, but we are value orientated. We do think the price that you pay on entry is a good determinant of the returns you make over the holding period, and our holding period does tend to be we count that in years, so 2 to 5 to 10 years even. And we look to provide constant growing income from the trust using investment trust tools like leverage and the ability to smooth dividends through times of volatility by using reserves. So we use all of those tools to provide a consistent growing dividend for the trust. In terms of why overseas income, I just spend a few minutes talking about kind of some of the dynamics around the world. Historically, UK investors have been, and all investors tend to be biased towards their home market. Whether you're UK, US, European, or even Japanese investors, you tend to be biased towards the home market, and that's not a bad thing. That's where you live, and that's where the currency that you're going to spend is. But in terms of dividends, the UK has got a relatively concentrated dividend portfolio. So in 2023, 59% of the dividends paid by the FTSE 100 came from just 15 stocks, and those are stocks that are the likes of Shell, BP, HSBC, and unfortunately over the last decade there have been a number of occasions where some of these stocks have had to rebase their dividends. 24% of UK portfolios are allocated to UK assets, and that's probably a bit higher when you look at income portfolios, but 4% of assets of the global indices are UK. So, there are a wide world out there. There is a wide world out there of dividends from other areas of the world. You can see there 5.2% of global dividends come from the UK. In terms of where those dividends come from, if they're not coming from the UK, it's worth saying that is changing over time. So when I started my career back in 1998, a number of markets around the world, particularly areas like Japan and the US, were quite low yielding and were not known for dividend growth. We've been producing a study since 2009 that tracks dividend growth, and the aim is to help investors understand how good companies are about generating cash for you, regardless of what the market is doing. One of the surprising things from that study is how good the technology sector has been at growing its dividends over the last 10 years. It's been the fastest growing area around the world, and it's been driven from both the US and from Asia. And so we've seen strong growth coming from companies because it was quite an immature industry, the technology industry, if you compare it to areas like concrete, consumer staples, where there'd been a lot of consolidation. In the early 2000s, there was a bit of a free-for-all. There were lots and lots of competitors, lots and lots of semiconductor companies, lots and lots of software companies. I think we would all agree nowadays, many of us use the same products, whether they're Apple products, whether they're Microsoft products, and these companies have been growing their dividends quite handily since about 2015. I'm not quite sure what's happened to my presentation there, but I'm gonna carry on anyway. Other areas where we've seen a significant change in growth over the years has been from the Asia Pacific area. So unusually, we are seeing governments in both Korea and Japan encouraging companies to pay dividends because they are holding large amounts of cash on their balance sheets. And because I think there's a perception there that companies don't operate fully for investors' benefits. And so, and that's been something that's held those markets back from a capital point of view for the last 20 years. Is a kind of feeling that the companies are operating sometimes either, in Korea's case, for the families that are involved, or in Japan's case, they like to have diversification. They like to have very strong cash balance sheets, even though debt levels are very low. And what we've seen, and as a result of that, the returns these companies provide on investment have been quite low. So international investors have put them on low valuations. So we would say there is a link between the actions of companies around distributions to investors, both in buybacks and dividends, and the kind of returns that you might make in the future. So Japan, Korea, and these areas for us are areas that maybe 20 years ago you wouldn't see us doing very much in, but actually are becoming far more interesting than they've ever been. In terms of how we invest, in terms of hint, well, first of all, we're part of the Janus Henderson Investors Group. Some of you might just know us as Henderson. We celebrate our 90th year this year, which is very exciting. We've seen no one's been here for 90 years, but we've certainly seen a lot of cycles across the firm. And crucially, we're much more diverse than we've ever been. So of the 280 billion that we manage, almost a third to just over a third of those are in US equities. So we've got large US equity teams that help me choose stocks. But we've also got a lot of investors here in the UK, based in London, covering Europe and the UK. And we've also got investors in Singapore covering the Far East, and even in Australia doing commodities. So wide range of teams feeding in ideas that we can choose from. In terms of how we choose those ideas, people often ask how we funnel those ideas. I think what I would say firstly is from a value perspective, we very much focus on cash flow. And so the reason we focus on that is because that allows companies to invest for growth in the future, but also to enable them to pay dividends at the moment, but also to pay down debt over time. So looking at cash flow is very important for us, rather than necessarily looking at just very low price to book value or very low price to earnings. What we love is being paid to wait. Hopefully we don't have to wait too long, but we love investing in companies where we see a really interesting company that is undervalued at any one time. Perhaps a cycle is out of favor. Perhaps like at the moment, there's considerable uncertainty around China's growth. There's considerable uncertainty around President Trump and what he might do. And there's also, very sadly, a few conflicts going around the world. One of the ways that we look to try and help generate returns through those periods when we're investing in some of these undervalued areas is that dividend gets us being paid to wait. So it allows us to pay you the dividends, but also it allows us to kind of compound and get a return from our investments through periods when perhaps the market is slightly uncertain. Things that we look for really are leading companies, defensible competitive positions. They take a lot of different forms. I would say one of the areas that people have most underestimated, how stronger competitive positions there are, is the technology sector. I think when I started in the industry, particularly just after the dot-com bubble, there was a feeling that actually technology barriers were quite low, and that you would see new competition coming in, a lot of capital being thrown into areas. What we've seen over time is a lot of those early areas have become much more consolidated. Now Amazon has won very much in international in shopping areas. We're seeing 3 or 4 big companies that are dominating kind of the devices that we use, and we're also seeing an increasing domination in the cloud. So that would give you an example of where people think of brands being Coca-Cola, Pepsi, Unilever. Increasingly, they are in areas of healthcare and technology. What's crucial in these areas is finding companies that can invest going forward, and that's the best way to avoid value traps. I think people do ask me, how do investors avoid value traps? There are a lot of cheap stocks out there with high yields, and one of the key things is making sure that there's not lots of new entrants coming into those markets. For us, being able to invest in a wide selection of sectors and regions has been key, rather than any one particular trend. So this chart here shows the total return of the trust since we launched it in 2011. I remember it distinctly because in 2011 I had my first daughter, and yeah, I was away on paternity leave, and there was a crisis in the US debt straight after, and the trust fell from £1 to 82p. It turned out to be a great time to invest, so we were quite lucky in that basis, but we didn't foresee it, is the point. So this point at the front, I'm not going to spend a lot of time telling you exactly what we're going to think is going to happen through the next few years, because actually this last decade has been very, very unpredictable, and to say that it's going to be any more predictable, I think, would be wrong. What we can say is actually, investing in different areas and being able to move where you invest is important. So at some point, investing in property was a very good investment for us through the kind of 2015 to 2018 period when interest rates fell. We're currently very low in property because we were worried about what would happen when interest rates went up. Areas like the China slowdown in 2015, what you can see on the bottom line here, below the line, on the right-hand axis, is we use gearing, so we are able to borrow as an investment trust. We've actually issued in 2019 30-year debt denominated in euros at around 2.5%. So this increase in interest rates has not had much impact on us. And you can see there we've been up to 16% in terms of using that leverage when we see opportunities to try and enhance the returns on a long-term basis. At the moment, we're not very levered. We're not using very much debt, and that's partly a reflection that we just had a significant rise in interest rates, and that was something that, to be honest with you, I've been worried about. I've been worried about how markets and how the debt markets and how property markets would react to higher rates. Touch wood, I would say so far it's been absorbed relatively well. One or two US banks have unfortunately gone bust last year, but other than that, it's been something where there's enough growth in other sectors that has kept things moving on. So, we're well positioned to be able to deploy that leverage going forward if we see opportunities. This is one of the key focuses of the trust. I think for the products that we run on my desk, on the Global Equity Income desk, what we really want to be able to offer you as investors is something that you buy and it helps you protect against inflation over time. This is the dividend paid by Henderson International Income Trust annually since we launched. That first year was a short period, but we launched with 4p per year, and now we're up to 7p. So we've almost 8p. We've almost doubled our dividend over that time, and that's come from investing in companies that are growing their dividend. Some of those we've held a long time, and other times it's recycling that capital out of areas that have performed well and investing in them in areas that we think have more upside for the future. In terms of where we're investing at the moment, these are the top 10 from the portfolio as at the end of August. Microsoft is there. It's a company we've held for over a decade. We bought it with almost a 3% yield, and I'm pleased to say we've held it through. It's changed a lot, and I think that's the key thing about well-run companies is they change over time. When we first invested in it, people were absolutely obsessed with the number of PCs being sold in the world because the main money they made was on licenses. Now people are much more interested in trends around how much software they're selling and their demand for their cloud business. And also now they've got a big stake in ChatGPT, and they're leading in the forefront of artificial intelligence. So, the story there is one that's changed over time, and the ability to run that position has been important for us. A newer position would be something like American Tower. That's a company where these are telecom towers. They were stocks that got quite expensive actually when interest rates fell, but then when interest rates have gone up, because they are long defensive income streams, they fell back. And so this is this company that we've bought more recently, where we see an opportunity. It's been oversold by the market, and we think there's an interesting opportunity there that is almost independent of economic growth, for something where we're seeing increased use of technology and 5G being important for all sorts of technologies, which I'm going to touch on later. In between there, we've got some healthcare in here and some consumer staples, which are less economically cyclical. And actually, we've got one financial in the top 10 here, which is Amundi, which is a fund manager. But actually, financials and technology are our two biggest sectors at around 20% each. I thought, we can't really talk at the moment without talking about technology. It's been the biggest change that we've made in the portfolio over the last year and a half. Last August in 2023, and the year before that, there was a big sell-off in technology, partly because some of the trends around COVID were over extrapolated. And then we saw technology sell off. We saw an opportunity to increase the position in the fund from 8% to 20%. I would say what we talk about internally in this is it's going to be more than just about NVIDIA, and it's going to be more than just about Microsoft. In order to build out the capabilities for artificial intelligence, it's going to take a long time, and we still don't really know who the winners and losers of that are going to be. And so you can see this chart here talks about waves. And so the first wave was the mainframe, the invention of the mainframe in the 1950s, and that lasted 20 years as companies started to implement processing power. We then had the PC and the internet through the 80s and 90s. Mobile, and particularly to the consumer, has been the big thing in the 2010s, where many of us have benefited from having faster access to the internet on the go and all the applications that have come from that. And this one is about artificial intelligence. And what we're seeing here is we're very early stages, and so far it's been more about enterprise actually. So it's more about businesses trying to invest. And one of the things we found at the moment, the businesses, including ourselves, have to do, first thing is we have to get all our data on the cloud so we can use it. And so there's a wide range of companies, from US software companies such as Oracle and database companies through to the Far East. So that most of the equipment that is used to build out this infrastructure is coming from Hong Kong, Taiwan, Korea, Japan. This is where a lot of the production has been outsourced to over the years, and these companies are seeing very good growth from technology. Sadly, we don't have a lot of it in the UK at the moment, and there's not very much of it in Europe. So the main opportunity here for European and UK companies is harnessing that technology for productivity. It's not just AI that's important. We're seeing technology being rolled out by government policy is focusing on things like energy security. So decarbonization is one thing that's pushed companies, but also we've seen companies being thinking about how we reduce our reliance on fossil fuels from areas that aren't very reliable. So what's the point of this chart? Well, actually, it's not just semiconductor chips, it's utilities, it's industrial companies, it may be materials companies like copper that are important to building out this infrastructure over the next 5 to 10 years. The trust, we are about 70% developed markets in terms of listing, but we are, what I'd say is that hides the fact that 75% of our revenues from the underlying companies are coming from fast-growing economies. And I would include the US in that. I think the US is one of the faster-growing economies and is likely to stay that way for a number of years in the future. And you can see there emerging Asia, emerging other Asia. When you put those together, about 75% of the revenue from our companies comes from some of these areas, and that's really what's driving the growth in the dividends. I'm pleased to say we've just been awarded the AIC Next Generation Dividend Hero, so that means we've grown the dividend for over 10 years, and certainly I would very much hope that whoever might be running Henderson International Income Trust in 20 or 30 years, if it's like some of our other trusts, that there'll be a long continuous track record there of dividends. The yield as of today is 4.4%. And over the last 12 months, we've seen a good share price return, 17%, slightly behind our benchmark. And I think that was from a very kind of depressed position last year. So whilst we are seeing valuations being higher than they were a year ago, I think on a global basis, we're still seeing valuations being quite moderate versus history. I'm going to wrap up here and take questions. I'd just like to thank you for your time. And just repeat those key messages. We were designed to help UK investors diversify their investments. We have no UK holdings for that purposes, and I'd like to thank you for your time.
Lovely, Ben. Thank you very much indeed. And we've only got a few minutes, and we're quite quick with the questions, if that's okay. The first up is that the growth in dividend per share is clear. However, the rate of growth per annum has been slowing. Now, thinking about the share price, what's your guidance or objective, I guess, on the growth rate?
The growth in capital, that is?
Yes, I think that's growth in capital, Ben.
Yeah, we very much aspire to grow capital through the cycle. I think for the total period, we're probably compounding around 8%. It has been a bit slower in recent years. Outside of technology, we've seen markets being more subdued. I think they've been absorbing this interest rate increase. I think for parts of the world, such as emerging markets, we do need interest rates to start coming down, particularly US rates to start coming down to give them a bit more breathing space. And I think that's the same in the UK as well. So, I think if the market has become polarized, a quite narrow area of AI, I'd like to see it broaden out, and I hope to see that happen over the next 5 years.
Next question is a similar sort of theme. It says Hint talks about performance over 1, 5, and 10 years, and it says there's a high degree of variance in performance. It says your investment trust style is clearly different from other trusts in the sector. How is it differentiated, and what's the key investment case for your product versus, or what would you feel would be the key case for you?
Yeah, it's a good question. I think we have a higher yield, so we have generally a higher yield than the other trusts, and we have less in we've got a lower valuation, we've got a more of a value style. For the last decade, value has underperformed growth as a style. Historically, over long periods of time, buying cheaper companies has been more successful. So I think the case for us would be we're a good diversifier. If you have those other trusts, and if you have other trusts in other areas in global growth, we're a good diversifier. That if you go and look at in 2022, our performance was much more stable than them. There was a big sell-off in technology. If AI does turn out to have a pause, a lot of stocks are not prepared for that pause. If we suddenly start to question AI and whether it's a growth area for a while, I think you'll see a benefit to having diversification.
Thank you. Next one. Are you expecting Trump's tariffs to drive inflationary pressure in the US, and what actions do you expect to take to maintain income above any resulting inflation?
Yeah. The textbook answer is that tariffs tend to cause a one-off peak in inflation rather than a consistent peak. So a little bit like recent years where we saw supply shocks causing inflation. The other aspect of that is quite often they are associated with slower growth. So the higher input prices are associated with slower growth, and that slows inflation. I think the better answer is be very, very careful of companies that are exposed to the tariffs. So I think what we've done in the portfolio is gone through, if you look over the last year, and we've taken out a lot of things like autos. We've taken out some of the areas where they would be exposed to tariffs. I think the other thing that is probably more inflationary is that Trump wants to cut the tax rate to 15% if he's allowed. And I think that would be more inflationary for the US than tariffs per se, because that will be quite a big fiscal boost and that will last for a longer period. And that's what we saw last time round. He dropped the tax rate, deficit went up, and actually there wasn't a big spike in inflation, but we did see an acceleration in growth.
Final question then about dividend cover and resilience of the dividends in the portfolio companies. And could you talk to that? What's the blended dividend cover for the portfolio?
In this last year, it was 87% was the cover. So we've deliberately been spending some of the reserves built up in previous years to allow us a little bit more flexibility to access some of this technological investment in lower yield areas. Generally, if you look over time, the dividend cover has been 100 and around 80%. Well, for a long time, it was more. We built up reserves for a long time.
Ben, we are out of time. Thank you very much indeed for joining us this evening.